Good evening and welcome to Current Issues. I'm your host, Hesham Tillawi. Well, tonight it's going to be a little bit unusual because we will be talking about things that we normally did not talk about, or normally we don't talk about. We talk about politics, we talk about all kind of stuff, elections, but we never talk about taxes, and it is tax time. And with tax time comes all the headaches. That's actually my expertise, or the area of my expertise, and I can talk about it. We're going to talk about tax tonight, and it will be informative. It is not political. It's not an opinion. I will be talking to you about tax because I am a tax professional. Do not take what I'm telling you as an advice, because I'm not advising you. If you need to a tax advisor, get a tax advisor. But I will be giving you a lot of information that you might find useful in getting your tax preparation underway. So again, it's tax time, and we will be talking about tax. Now, we never done this before in prior years because I just did not want to talk about the taxes. I wanted to talk about politics, and as a matter of fact, I had prepared a program for you tonight about politics, about what's going on in the world. But I decided today, and today only, that let's switch gears and just put politics aside, since we are current issues, and the issues of today is taxes. So again, it is tax time. Well, tax time, you will be looking for a tax preparer, and some of you might be actually looking to do it yourself. Well, regardless, if you are one of those who want to do it yourself like I used to be, or you trying to find a tax preparer. Now, there are a lot of tax preparers out there. And, I'm not going to recommend any of them tonight, not even the tax firm that I work for on daily basis. But we are going to tell you and advise you, when you look for a tax preparer, find one that you can actually trust. And find one that is not going to make you do things because you're going to get more money. Again, you might say, what did he say? Yes, you heard me right. Don't go with the tax preparer who's going to give you more money than the other guy. If you go to any tax preparer, and if they are professionals, you should come out with the same figure, provided that you've given them the same information. So again, if you're shopping around from tax firm to a tax firm, and there are thousands of tax preparers that are not the everyday, name in taxes. There's about 3 or 4 big companies, franchise companies. They have branches all over the United States. Now, I'm not recommending that you go to them. If you have a mom and pop tax preparer, a one-man office who has been doing it for you all this time, and you are satisfied with them, fine, stay with them. But the advantage when you go to bigger companies, they have more resources. They have more resources to keep updating their information, and also they have more resources that they want to make sure that you don't get in trouble. Because if you get in trouble, that's not good for them. So when you look for a tax preparer, you want to look for someone who's going to be there in case if you have a problem. Because remember, a tax preparer is only someone that prepares your taxes for you, and you sign on the dotted line. So whatever they put on your tax return, you are ultimately responsible. You can't say, oh, the man that did my taxes did that. No, because you sign. It's not them. And when the IRS going to audit anyone, it is going to be you. So don't let them do something that's going to bring you more money illegally, because in some instances, you might find yourself in jail. You might find yourself arrested. So, anyway, this is what we have. I think my producer there is sleeping because they're not changing the pictures as we talk. They're probably on their Facebook, probably, or texting. So again, and getting back to what we're talking about, you got to prepare yourself for the tax season. Now they are paying attention, and they're changing that. So hire a tax pro. That's my first advice to you, is find someone who knows something about taxes. Don't go to your friend who did it online because he did his and then he can do yours, or somebody that's going to do his or do yours online and then bring you all kind of money that you're going to split up with him or her. Don't do that. Go to somebody that is legit. Go to somebody who's a professional, because if you don't, you might find yourself in trouble, and then you will go, then the IRS is going to be coming after you, not after them. I know there are people out there who are going to tell you, hey, look, I'm going to bring you $4,000, $5,000, just give me $500. And you probably say, you probably went to H&R Block or something, or Liberty or Jackson Hewitt or whatever, and they told you, well, you're getting back $3,000. Then your friend says, hey, look, I can fix you up, and all of a sudden, they can bring you like $5,000. And you might say, well, you know what, $5,000 is more. Well, guess what? They're not going to be the one going to jail. It's going to be you going to jail if you cheat on your taxes. So, you do want to go to a tax professional so you won't find yourself in trouble with the IRS. When we talk about taxes, the tax code is very complicated. Tonight, we only going to be going with the simple stuff, like W-2s. That's the document you get when you work for somebody. Or a 1099. That is a document you get from a company that you worked for them, either as an employee or as a contractor, as a self-contractor, or self-employed sometimes it's called. So if you get a 1099, at first you want to look at if the amount the company gave you is a number 3 on the 1099 or a number 7 on the 1099, because it makes a lot of difference, a big difference when you come to do your taxes. Now, if you are self-employed and let's say the company gives you a 1099 and it's on number 7, which is unemployee earning. If it's a number 3, it's employee earning. Maybe it was a bonus, maybe it was unreimbursed expenses that you had. But if it's on number 7, and even if you don't have a 1099, let's say you cut grass out there, or you braid hair, or you it doesn't matter, whatever, you babysit, you clean houses, anything you do, you can claim that as a legit income for you. But you got to be careful. When you claim self-employment, you got to be careful. You don't want to get audited by the IRS. Now, if you did not work for anyone but yourself, if you babysit in your house, well, you can claim that income. Just make sure your books are set up right, and it's very simple. Someone pays you $40 to babysit, just write down the date, who gave it to you, in a logbook. That's it. Now, if you want to be elaborate, you might give him a receipt. Then you will have a receipt book. Now, if you do hair at your house, or if you cut grass, well, it doesn't matter. You might sometimes work on someone's car on the side, on the weekends, or whatever, and you want to claim that income. Well, in order for you to claim that income, you need to make sure that you don't have to go and get licenses and all that stuff. You don't even have to have business cards, but it's good if you do. If you look like a legit business, well, if you are a legit business, you need to look like a legit business. So, record keeping is extremely important. Expenses. Make sure you write down what you buy. Let's say you braid hair, you do hair at your house, you do fingernails, whatever you do, you have to have supplies. So make sure you keep all those receipts. Equipment, you buy a lawnmower, you repair a lawnmower, you do whatever you do. As a business, you get to deduct virtually everything that you spend for the business. It does, if it's a business expense, you can deduct 100%. So if you get a 1099 and the money is a number 7, which is not an employee compensation, then you can deduct all the expenses to go with it. Now, sometimes people say, well, can I deduct my mileage to go to work? The answer is no. You cannot deduct your mileage to go to work if you are just commuting back and forth to your job. But now, if you use your car on the job, let's say you use your car to go from one place to another place to another place, and you're not being compensated for by your employer, then you can. But going back and forth, no, you can't. Now, let's say your job takes you to Baton Rouge. Well, you can deduct that travel. Now, in deducting, now let's go back to when you get a W-2. Number one, when you get a W-2 from an employer, you will see now you have Social Security and Medicaid taxes taken out. That is a percentage everybody pays for. So everybody pays very much the same percentage on Social Security and Medicare. You don't get those back. That money, it's gone. Now you can look at a number 2, you will have withholding, federal withholding. Depending on now you're not going to get all that back, but depending on your income, you might get that back. For instance, if you made less than $10,000 and you're single, I guarantee you're going to get all that back. Because if you are single, as a matter of fact, let's talk about who has to file taxes. Well, anyone that made less than $10,000 does not have to file taxes. Now, even though we say does not have to, the question is, should they file for their tax returns? And the answer is yes. There are many reasons why you should file for a tax return. For instance, now, even though you don't have to file for a tax return if you made less than $10,000, well, even if you made $5,000, well, your employer may have took some federal withholding from you. Well, you will get all that back. Let's say you are between the ages of 25 and 65. Well, you get what we call earned income credit. And depending on your how many dependents you have or no dependents, that's what says how much money you're going to get. Now, the filing status, you say, well, what would I do? Would I go like single or head of household? Well, let's talk about single. Single if you are by yourself, or sometimes you might even have people living with you that you are claiming as dependent, but you can't do, let's say, head of household. Now, the other, you have, well, the five filing status that we have, it's you have single, you have head of household, you have married filing jointly, married filing separately, and qualifying widow. Now, what is the difference between all those? Well, married filing jointly and married filing separately, that's the people, the married couple have to decide. Now, is it better to go married filing separate or married filing jointly? Well, the rule of thumb is you want to go married filing jointly. That's the rule of thumb. Now, is it always better to do it that way? No. Now, but also remember, both have to agree on married filing jointly. So if one of them does not want to do married filing jointly, you can't force them. You cannot go on your own and say, I want to do married filing jointly. No, your spouse have to be with you, and you both have to sign the tax return. But now, besides personal reasons, sometimes people might have personal reasons that they don't want to file jointly. Whatever that personal reason is, we're not going to get into the many personal reasons, but as far as tax reasons, return reasons, you might want to do it both ways. Do it married filing jointly, and then do it married filing separately, and then decide which way is better. But I can tell you the rule, because married filing separately, you lose a lot of benefits. You have to decide, is losing these benefits better or worse? You have to decide that by actually doing it both ways. But, a lot of times I get asked, is it better to go married filing jointly or better to go married filing separately? My answer is the rule of thumb, married filing jointly, because you get a lot of benefits. But sometimes, depending on the situation, one of them might have made a lot of money and the other one did not. Whatever, you just have to play with the numbers and see which one. But it is your choice, so you do not have to. And by the way, you do not have to live with your spouse to go married filing jointly. You could be living in different cities, but you're married. But married people have only two ways to file: married filing jointly and married filing separately. There is an exception to that rule, which is it's called considered unmarried. Considered unmarried is this: married people, if the husband or the wife, they did not live together in the last 6 months of the year. Now remember, the last 6 months of the year, then the spouse, and it could be both of them, if they have children, they could be considered unmarried, and for filing purposes, they could do head of household. Again, the information we've given you is for information only. Make sure you check your own situation with your tax professional. But again, married people they can go both ways: married filing separately or married filing jointly. If the spouse is out of the house for the last 6 months of the year, you will be considered unmarried and you can do head of household. Because if he's out, the last 6 months, probably, the likely that they will do married filing jointly is slim, even though they're still married, but they're separated. So, are you going to get them to file together? Maybe not. Because of that ruling, especially if you have a child with you, then you can be considered unmarried for tax purposes and do head of household. Now, when you do head of household, you see the difference is when you do married filing separate, you lose a lot of benefits. It's just like single. That's what married filing separate is. It's just like single. With head of household, you get a lot more benefit than that. Now, so we got single, and that is anyone that either on their own, by themselves, or even if they have somebody living with them, but that somebody does not qualify them to be head of household, which is normally it's a child, because in order for you to be head of household, you have to have a child living with you, and there have to be a relationship between you and that child. Now, in today's society, we have all kinds of combinations of people living together. a man living with his girlfriend and her children. Well, what can he claim the children? It all depends. Let's just go with the rules. Let's learn the rules. Number one, a dependent can only be, well, let's go back. If you are a taxpayer, and if you are a taxpayer, there is a table that if you are single and made less than $10,000, actually this is for the earned income credit, not what we're talking about. But we're going to talk about this one in a little bit. But if you make $10,000 or less, you're not a taxpayer. Let's say you made less than $10,000 and you have a child. If you're not a taxpayer, then your child is not your dependent, even if you go in to file taxes. Again, let me repeat that, because there's a lot of situations like that, and a lot of people, sometimes they get themselves in trouble because, the boyfriend made the money, so he claims the child as his own, and he gets the earned income credit, which is $3,000, $4,000, $5,000. That's what I want to talk about mainly tonight, because I don't want you to get in trouble. It's tempting, and a lot of people are doing it out there, but you know something? You can get away with it for so long, and all they have to do is catch you one time. Now, if you know you're doing something wrong, don't let a tax preparer convince you to do something you know it's wrong, even if it's going to bring you more money. I would rather go away with my $1,400 return than getting $6,000 that I lied on the return. And then, now the tax preparer is going to get his cut. He's going to make his whatever, $300, $400, whatever people charge. And if you go and do it with these, off-the-wall tax preparers, he might tell you, look, you're getting $1,500, but I can get you $5,000. You're going to have to give me $1,000. And guess what? Many people out there will say, okay, we'll do it. Once the tax comes in, we'll give you $1,000. Don't do that. If you get in trouble, he's not the one in trouble. You are the one in trouble. You have to pay that money back. Now that's if they figure out that you were innocent, ignorant. If you convince them and they decide not to press criminal charges against you. Our job as a tax professionals is to actually make sure that you're not going to be in one of those categories where the IRS is after you. The least they will do is they're going to make you pay the money back plus penalty plus interest. And guess what? You might be able to run away from a credit company or a loan here and there. You cannot run away from the IRS. Even after you are dead, you still owe that money, and they will go after your estate and they will get their money. The government will get their money. They will garnish your wages. They will do whatever. They will intercept your returns, whatever. The best thing to do if you find yourself in that situation is make a deal with the IRS and move on with your life. Don't go for years and years and years ignoring them. They're not going anywhere. We will go away before they go away. So the IRS is there to stay. Don't think you're going to beat them. You might run away from them for a couple of years, but they're going to ruin your life and make your life miserable until they get their money. So don't get started with it. Don't get in that situation to start with. So let's get back to the earned income credit. Number one, if there's no relationship between you and that child, blood relationship, or an official relationship that was created with like a government entity, for instance, like marriage. Now, marriage, then yes, they become your stepson, stepdaughters, etc., just like your children. But if you're just living with a girlfriend or a girlfriend living with a boyfriend and he's not working, she's working, and she's supporting the family, and let's say he has a little kid, Well, guess what? If he's not a taxpayer, and remember, a taxpayer is someone who made $10,000. Now, that's for single. Now, for other designations, it's more. Like for married people or people over 65, or so it's more the money that you have to make before you become a taxpayer. Find how much that money, it really doesn't matter, because most likely everybody, even if you're not a taxpayer, you might want to file so you can get the credits. Filing taxes, it's probably the most socialist system. I can describe it as, it's a socialist system. It's basically spreading the wealth. That's what it is. It's spreading the wealth. And now how they do that? Well, they do that with this earned income credit and other credits that they will give you. Like child tax credit, etc., etc. Now, the earned income credit is something that many people actually get in trouble with. And it's the most tempting. Because actually, you can get, like for instance, if you look at this, table that we have here, it shows how much money maximum. Now remember, if you don't have any kids, you will get $487 if you're single. Now that's maximum, and we're going to talk about what maximum means. If you have one kid, you get $3,250. If you have two kids, you get $5,372. That is credit that you will get. And if you have three kids, because remember, you can claim up to 3 kids. And if you have 3 kids, it's 6,000 something. So it's tempting. If you have 3 kids and you're looking at making $6,000, I think many people will be bending the rules here and there. And a lot of people are. 24 million returns back in 2012 that actually used the earned income credit. Now, does everybody get that? No. So if you have one kid, are you going to get $3,250? No. You can. That's the maximum, depending on your income. So some people might ask me, well, if I make more money, do I get more earned income credit? The answer is yes and no. If you are in a certain income bracket, the answer is yes. The way the earned income credit works is this. And we're going to get back into the girlfriend-boyfriend. I know some of you are waiting, like, okay, he's talked about it for a couple of times. So make sure that you get a tax pro to do your job. And I have a guy waiting here. He wants to come around and wave for the longest time. So you can do it while I'm talking. And he's going to, okay, here we go. Now, too much light over here. Okay, let's get back. The way it works, it's called earned income credit. It doesn't mean if you have 2 children that you're going to get $5,000. That does not mean that. That means you could, and that means you could get as much as that depending on your income. So, sometimes we get, 2 sisters. This one has 2 kids, the other one has 2 kids. You do one and you say, okay, you're getting $7,400 back. And we do the other sister and, okay, you're getting $2,200 back. It's like, well, wait a minute. Why she gets $7,000? She has 2 kids, and I have 2 kids, and I only get $2,000. Well, look at the income. That's basically where it's at. The earned income credit, that's what it is. It's called earned income credit. Based on your income. Now, you guys in the upper, like if you're single and you make like more than $20,000, you probably don't know what I'm talking about. Or if you have 1 kid, then you make more than $38,000, you probably don't know what I'm talking about. So higher income, you're not going to get that earned income. The way it works, if you're not making money, you're not going to get that earned income. You make a little bit of money, you're going to get a little of that earned income. Go up, it goes up. Go up, it goes up until it maximizes and levels off. Then if your income goes up, your earned income goes down. If your income goes up, your earned income goes down until it zeroes out, and which means that you're not going to get any earned income. Now, what is earned income? It's money the government gives to people. There are people out there by the millions who do not pay any taxes, zero tax, zero. They don't pay nothing, zero, and they get thousands of dollars. That's what's spreading the wealth. That's the socialism that we have. Now, is it right or wrong? That's not what I'm here to talk about. I'm here to tell you how the system works. Now, let's get back into the boyfriend-girlfriend thing. You can, now remember, a dependent can only be one taxpayer dependent. If you are a taxpayer, then your dependents are your dependents. You cannot sell them. You cannot give them to your mom to claim them. You cannot give them to your neighbor to claim them. You cannot give them to your boyfriend to claim them. No, they are your dependents, and guess what? You do not have the right to dispose of them. Your dependent is your dependent. Let's say you have an 18-year-old student or in college, 24 and below. They work, they want to do their own taxes. But if they are your dependent, they're your dependent. But they want to do their own taxes. They're still your dependent. When they go to do their taxes, now they can do their taxes to get back the not the earned income, but to get back the federal withholding. So if they worked for, let's say, $2,000, $3,000, and they have about $600 withholding, let's say it's that much, well, they can file to get withholding back, but you still claim them on your tax return as your child and get the full credit for it. A lot of parents sometimes, they say, well, we let him claim himself. You can't do that. Now, if you don't want to claim him on your return, that's your business. But did he get any benefits for claiming himself? No, he did not. You lost all the benefits. You lost the exemption credit, and based on your income, you may have also lost the earned income credit. You may have lost other credits. So remember, your dependent, your children are your dependent if you are a taxpayer, all the way to below 19 or 24 and in college. Now, if they're not in college, well, 19 is the cutoff. Let's get back into because we have a lot of this that goes on, and people lie and people get in trouble. If you're not a taxpayer, let's say you are the boyfriend and you have a 8-year-old son. Your girlfriend is the one that's bringing the bread home. You made $6,000, so you're not a taxpayer. Remember, if you're single, you made $10,000 or more, you are a taxpayer. That's the definition of a taxpayer. Now, does that mean you can't file if you made less than $10,000? No. All it means is you don't have to file. But should you file? Most likely, yes, to get back what you put in. And if you're over 25 years old, you will get some earned income, even if you don't have any children, like $487 or so maximum. Let's get back into the scenario at hand. So he is not a taxpayer because he only made $6,000, but he's going to file to get the federal withholding back. His 8-year-old, can the girlfriend claim him on her taxes? The answer is Yes, she can. But she can only claim him for the exemption credit. She cannot claim her to make her head of household. She can come and say, well, look, I am paying the expenses, and the definition of head of household is if you pay in more than half of the expenses in the house and you have a child living in the house, then you are head of household. The answer is no. That's not enough. In order for you to be head of household, you have to have a relationship with that child. Well, can you claim him for earned income credit? No, you can't. Because relationship, again, there is no relationship between you and the child except his dad is your boyfriend. Period. Now, if the dad made $10,000 or more, he has to claim the child because he's a taxpayer. He cannot give, because see, sometimes, well, if the girlfriend claims him, they might get more money. And a lot of people do that. And that's illegal. So, is it worth it? I can tell you it is not worth it. Because eventually, now they may not come after you this year or the next 2 years from now. You might get a letter from the IRS. Well, we need you to prove relationship with that child. We need more documents. And then how can you prove relationship? Now, at that time, you had no relationship with the child. So again, what you can claim, be careful, make sure. Now, you can claim anyone. If you have anyone living with you, it doesn't matter what their age, you can, and it doesn't matter if you have a relationship with them or not, you can claim that person for what we call the exemption deduction. Now, what's the exemption deduction? Well, now it didn't used to be that way, but now it is. They don't have to be your relatives. It could be of any age, provided that you have provided more than half of their support. Let's say, they're living with you in the house. And also provided that they did not make $3,950. Now, if they made that much, then you can't, or $3,900. So if they made that, you can't. But if they did not work, or if they made a couple of $1,000s, then you can put them on your tax return regardless of the relationship with them. But the only thing they're going to actually help you with is you do not have to pay tax on $3,900. I mean, it might work. I mean, when you pay tax, depending on the bracket you are in, it might be 15%, 20%, 30%, it might be 40%. So whatever the bracket you are in, it might help you. I mean, 20%. So it's going to help you by taking that. It might even put you in a different. Well, no, it's not. But that's what dependency exemption means. So let's say let's get back into the. Now I think we have. Let's talk about business. Let's talk about business. What can you deduct when it comes to business? And a lot of people, can we deduct uniform? Well, the rule of thumb is if that uniform can be worn anywhere else, then you can't. So let's say if you are, some people, there might be an attorney, their suits, and some people might deduct their suits. Well, they're not supposed to, because that's not a uniform. Well, yeah, but we have to have that. Fine, but you can wear that suit somewhere else. But like military uniform, police uniform, if you have to actually pay for that, yes. If you want to get, let's say they don't give you enough and you want to go and buy a couple of more and pay for it, yes, you can deduct that, because that's you can only wear that on the job. So if somebody, anything you buy to do your job with, and the company does not pay for it, you can deduct that. Now, people sometimes might say, well, I want to atomize. Well, what does that mean? We get people in there who say, I want to atomize because my cousin told me that if I atomize, I'm going to get more money. Well, most likely, it depends on how much your atomization is. But the government allows a certain deduction that's called the standard deduction that everyone gets. Now, everyone comes and says, I want to do mileage, I want to do my mortgage, I want to do this and that. And the answer is, by the way, we were talking about who's a taxpayer. If you look at this table, that's what a taxpayer is. If you made $10,000 or more, now if you're older than 65, then it's 11,000. If you are, head of household. If you're married filing jointly, then it's 20,000 if you're under 65. Married filing separately, it goes back to like 3,900. So be careful when you do married filing separately. Qualifying widow is 16,100. So now, what's a qualifying widow? A qualifying widow is, okay, let's talk about this one, then we'll come back and talk about, since they throw this table here. So let's talk about what a qualifying widow is. The year the spouse, I always say the year the husband dies, because normally it's that way. But let's say the year your spouse, well, not yours, the year the spouse dies, the surviving spouse has the choice of going either way. The year the spouse dies in. So if we're talking about 2013, if, God forbid, the spouse died in 2013, the surviving spouse can go either way, married filing separately or married filing jointly. It's the surviving spouse choice. Even if they never filed jointly, after death, the surviving spouse can decide that year. Now, it doesn't matter if death happened on January 1st or death happened on the 31st of December. It doesn't matter. You get to choose. The surviving spouse get to choose. Now, what is a qualifying widow? Qualifying widow, the next 2 years after, then you can choose that qualifying widow or widower, provided that you do have a child in the house and you do not remarry. So that's why it says qualifying widow or widower, because you have to have a child to qualify you. Otherwise, the next year, the following year, like 2014, it'll be single unless remarried, or unless you have a child that you can claim. Then it becomes now you can't. If that child, then you become qualifying widow or widower. That's what a qualifying, the tax thing, I'm trying to cover as much as possible in the time that we have. And I know I have went from one area to another, but if you have, what can you deduct? That's atomization. If you're not self-employed. If you're self-employed, you deduct everything 100%. Now, if you're atomizing, there's something called standard deduction that everybody gets based on their filing status. So, like the standard deduction for single, it's different than married filing jointly. It's different than head of household. It's different than a qualifying widow. Now, for single, you atomize if you have itemized deduction, if your itemized deduction goes up more than your standard deduction, then you get the highest of the two. Now, sometimes, people ask us, well, is it better to go with the itemized deduction or go with the standard deduction? The answer is there's no such an answer as better or not. You do itemization. If your itemization is more than the standard deduction, then automatically you will get the highest of the two. If your itemized deduction is less than the standard, you're going to get the standard. So there's no such a thing as shall we itemize or not. You itemize, and if you itemize more, if your itemized deduction is more, you're going to get it. If your itemized deduction is less than your standard deduction, you're going to get your standard deduction. And you can look up how much based on your filing status, how much what that number is. So, sometimes people, they keep all their gas receipts and keep all their medical bills and keep all, these receipts. Number one, you have to know what can be deducted in medical bills. Your medical bills have to be, if you go buy Tylenol and all that stuff, that's not deductible. But if it's like prescribed medicine, if it's, doctor's visits, even travel to go from the doctor, lodging if you go out of town, even food while you travel there, that's all deductible. Anything, it's just like expenses you spend for your business. If you spend it for medical, you get to deduct all that. Even parking lot, toll fees, and you can deduct everything for that trip to go for medical expenses. So people will be like spend all year collecting these receipts, and then when we do their totals, well, it's less than 10% of their adjusted gross income, and we say you're not going to get anything for it because it has to be at a certain time. And even if you can deduct those medical bills and the total of all your itemization with your mortgage interest, with your insurance on the house, with your whatever, if it's not equal to the standard deduction that everybody gets according to their filing status, then you're going to get the standard deduction. Does that mean you wasted all that time? No, you did not. It still gave you the highest. You just did not have enough itemization to actually do that. Let's see, what else? I guess let me spend the next few minutes that we have on getting you ready when you go to a tax preparer, especially if you're going to be claiming children. You might want to, number one, you might want to bring their Social Security cards. Bring anything you have with you, their birth certificates, their immunization cards. When you go to a tax professional and you claim in children, to claim that earned income credit, those children have to live with you. Oh, by the way, let me sometimes, with separated or divorced parents, now remember, a dependent cannot be on more than one tax return, except in the case of divorced or separated parents. Sometimes the court might mandate that, okay, he gets the exemption credit, you get the earned income credit. And I don't know if we're taking calls. Caller?
Hey, how's it going, buddy?
Good. Do you have a question?
What you talking about tonight? Taxes coming up?
Yeah. Okay. Apparently, they're not ready to answer. So please, we got only a few minutes left, so I'm not going to take any phone calls. So don't bother calling. And, if he would have had a question, I wasn't going to take calls because I do want to give you as much information as I can. So, I forgot what I was talking. Yeah. Children of separated or divorced parents. Now, sometimes they decide, okay, you get the exemption, and whoever the child lives with will get the earned income credit. So to get the earned income credit, the child has to live with you. Now, I know some divorced or separated parents, they don't go by those rules, and they go by which one is going to get more money. If it's court mandated that the husband gets the, let's say, the exemption credit, and the wife gets the other credit, what that means is the husband will claim the child as a dependent. He will get the exemption. The $39.50 will be taken out of his total money that he has to pay taxes on. Now remember, he's not going to get $3,950 and he's not going to get that credit. No. If you have $10,000 of income and you're claiming the dependency exemption because you have a child and the court said that you will have you can carry him as a dependent, then the only thing you can do is carry them as an exemption. It's going to help you with reducing your tax bill. Now, the other parent can actually, not as a dependent, but for credit purposes only, which they will get the earned income credit. The only one that can get the earned income credit is if the child lived with you. Now, that could be your brother, it could be your sister, it could be your, not cousin, but it could be your nephew, it could be your grandchild. If you have a relationship with that person, then you will, it's not just the parent, but if you have a relationship with that person, and the IRS have defined all these relationships, a stepchild, stepson, stepdaughter, whatever. And by the way, the relationship with that child does not end when the marriage ends. So they can still be your stepchildren. And we got a couple of minutes, and I'm trying to actually stuff as much information as possible. Let me tell you something. When you look for a tax professional, you want to make sure that that tax professional is actually there all year long. That's very important, because sometimes you might need to get a copy of your tax return. Are you going to go track them down? Because most of these people, they probably work only these 3 months in the season, and you have to be tracking them down to get your tax return or a copy of it. Because, some people, they just don't keep the copy they get. You want to look for someone that's open all year long. You want to look for someone that's going to be there. You want to look for someone that's promising you accuracy, promising you that if you get a letter from the IRS, that we're going to be right there with you to answer the IRS. If you get audited and you have to go meet with them, you want to look for somebody that's actually promising you that they will even come with you to help you. Now, having said that, tax professionals will make sure that you don't get in trouble. Now, if you want to lie, if you want to cheat, if you want to do all that stuff, it's better not to actually go to a tax professional, because they're not going to let you do that. And you should not do that, because like I said, if you get caught one time, they're going to go back. They're going to go back the year before and the year before and the year before, and it's endless. And they will make your life miserable. So remember, earned income credit, you want to take with you to your tax professional anything to prove that the child lives with you. It could be a letter from your pastor at church. It could be a letter from the school. It could be a letter from the apartment building. It could be a letter, but not a letter from your cousin that, yeah, those children live with you. So you want to make sure that that the children live with you. Anyway, it looks like we are out of time. And I promise you, next year, we will do this every tax season. And hopefully next year, we will be able to help you even more. Anyway, we only come to you once a month now. So we're going to see you on the 28th of February. And we will get back into the politics of things. Until that time, go do the right thing We'll see you next